Chapter 22 Business Finance Needs and Sources for IGCSE O Level Business. Agenda Responsibilities of the Finance Department. Reasons why businesses need finance. Types of expenditure, capital versus revenue. Internal and external sources of finance. Short term versus long term finance. How businesses choose their sources. Will banks lend and shareholders invest? Responsibilities of the Finance Department: recording financial transactions, producing accounting information, preparing final accounts, forecasting cash flows, making financial decisions. Why do businesses need finance? Startup capital to purchase fixed assets, buildings, equipment, and initial inventory to begin operations. Expansion to buy more assets, acquire another business, or invest in R&D for new products and markets. Working capital, the lifeblood for day-to-day operations, pay wages, buy materials, pay bills. A shortage can force closure. Types of expenditure. Capital expenditure. Definition. Money spent on non-current assets last greater than 1 year. Example. Buying machinery, vehicles or property. Revenue expenditure. Definition. Money spent on day-to-day operations. Example. Paying wages, rent and utility bills. Classifying sources of finance: internal versus external, from inside or outside the business, short term versus long term, for immediate needs or long term investments. Internal sources of finance: retained profit reinvested into the business. Advantage: no interest, no repayment. Disadvantage: not for new businesses, reduces owner dividends. Sale of assets, selling unused equipment or property. Advantage: no new debt, better use of capital. Disadvantage: time consuming, not for new businesses. Owner saving personal funds of the owner. Advantage: quick, no interest. Disadvantage: limited amount, high personal risk. External sources of finance Part 1 Issue of shares, limited companies only. Advantage: permanent capital, no interest. Disadvantage: dividends expected, loss of control. Bank loans. Advantage: quick, flexible time periods. Disadvantage: interest and repayment required, collateral needed. Debentures, long term loans from investors. Advantage: long term finance. Disadvantage: must repay interest and capital. External sources of finance Part 2 Factoring of debts, selling unpaid customer invoices for immediate cash at a discount, grants or subsidies from government or agencies. Advantage: often don't need repayment. Disadvantage: come with conditions, example, locations. Alternative sources Microfinance provides microcredit, small loans in developing countries, used when traditional banks refuse due to small loan size, less profitable, lack of collateral from borrowers. Examples: Grameen Bank, credit unions. Alternative sources crowdfunding, raising small amounts of money from many people online. Example: Kickstarter. Perks: no upfront fees, takes public reaction, fast fundraising. Drawbacks: risk of not raising the full amount, idea might be stolen, requires strong publicity. Short-term finance, working capital, overdraft. Bank allows temporary overspending, flexible but variable rates. Trade credit, delaying payment to suppliers, like an interest-free loan but can strain supplier relationships. Factoring, as previously described. Long-term finance, growth and assets, bank loans for a fixed period with regular repayments, hire purchase, pay for an asset and in installments Advantage: no large upfront cost. Disadvantage: deposit plus interest, total cost is higher. Leasing: renting an asset. Advantage: maintenance handled by lessor. Disadvantage: never own the asset, more expensive long term. Issue of shares or debentures, as previously described. How businesses choose key factors: purpose and time, amount needed, legal form and size, control, risk and gearing. Will banks lend? Banks are more likely to say yes if a business provides a solid cash flow forecast, historical and forecasted income statement, details of existing loans, security or collateral, assets to back the loan, a convincing business plan. Will shareholders invest? Shareholders are more likely to invest if the share price is rising, dividends are high, or profits are growing, the company has a strong reputation and growth plans, other investment opportunities are less attractive. Summary and key takeaways. Finance is needed for startup, expansion, and daily operations. Sources can be internal or external, short or long term. The best choice depends on cost, amount, legal structure, and risk. Businesses must present a strong case to banks and investors. Thank you.